Hi there YouTube, this is the first video in a series that I am making about common trading mistakes, trading and investment. If you'd like to hear more about these types of mistakes, please let me know in the comments. Alright, let's take a look. So the first mistake we're looking at in this series is the mistake of waiting to break even before closing a position. Now, this comes in two flavors. Either you held onto the position way too long when you should have sold it and moved the money elsewhere, or you sold it just as you broke even, but you should have held on because you just missed the best part. Now, I would say the best way to avoid this mistake is to know what you own. Do your research before you buy into the position and have a plan. And then invariably when things go wrong, let's say you have a position, you open it, and some point down the line, it's now sitting in the red and it sits there for 3, 6, 12 months, 18 months, and you get a little itchy, you're not happy with the position, and you're just hoping to get out of it. You just want to be out of it. So go back to your plan when you start feeling like this. Ask yourself the same questions you did when you initially got in. Why did you buy this particular company? Have the business prospects changed whilst the share price changes? Because the share price doesn't tell you how well the company is doing. It tells you investor sentiment towards the business. Has anything happened outside of the business that's affected the prospects of that company? Or potentially there are just better investments elsewhere. After some time, a particular stock that you've been watching sells off massively and you think that now it's a great time to get in, or they invent a new product or whatever. So something better comes along and you think you can make more money elsewhere. Asking yourself these types of questions will help you inform your decision whether you should be getting the hell out, taking a loss, moving your money elsewhere, or if you should be holding on and just waiting until the market sentiment catches up with the business fundamentals. Now, we, the humans, are basically meat robots. We're made of flesh and bone, and we run on electricity and food and water. But over the many years of evolution, we've evolved to behave in certain ways. Certain types of behavior, certain ways of thinking were advantageous to us back in the day when we were hunter-gatherers and maybe even farmers. But lots of these hangovers from those times are no longer very useful to us. And one of the challenges, the particular challenge in this case that results in the trading mistake that I've just mentioned, is loss aversion, but also the endowment effect. So over many decades, there have been many studies that have shown that we, the humans, feel losses twice as much as we feel gains. So a loss makes us twice as sad as gain makes us happy. And this means that we stay away from those things that we perceive to be losses. So when a position is red, we don't want to sell it, despite the amount of pain that we're experiencing and the potential for that money to be spent elsewhere and to make a better gain. And we want to wait until it just breaks even, and then we can sell in the green and there hasn't been any kind of loss. You know, obviously there's opportunity cost and time cost, but we feel a little bit better about ourselves. The endowment effect describes our ability to ascribe value to things that we own versus things that we don't own. And you probably experience this in your day-to-day. You will own things that you have certain feelings about, even though that they're just things. This is quite pronounced in children when they have a toy that they carry around everywhere for comfort, as an example, when all it is a physical thing. Now, even knowing about these things, the fact that they exist and recognize them in ourselves still doesn't mean that our behavior will always be perfect. And this is why I personally find that I need to write down my plans, that I need to write down my thesis and all the details around it and revisit it whenever I can feel myself slipping, when I can feel my discipline is being eroded by my emotions or just my human nature. Now, as part of this video, I'm going to look at a few examples because I feel like examples really cement these types of lessons, but just beware that we will experience some hindsight bias when looking at these historical charts. And hindsight bias is one of the most common biases that I see out there. I feel it myself, and I see it in various communities with people talking amongst themselves or perhaps with me. And so if you've ever felt after the fact that you definitely should have invested more in a particular position and that it was obvious and you don't know why you didn't, you're kicking yourself because it was so obvious, or that you didn't cut a position before a huge, massive drop and it looks obvious. Of course it was obvious. Just look at it. you are being subject to the hindsight bias. And this type of bias, this cognitive bias, means that we feel as though we should have been able to predict certain events when we have all of the information about the event after it has happened. No one has a crystal ball, and if it was true that people could predict these massive drops or when they should be investing more in stocks that climb enormously, then there'd be a lot more trillionaires walking around on the street. All right, so let's look at a few examples, knowing that there's going to be some hindsight bias involved. VW, Volkswagen, is a massive auto manufacturer that was a behemoth that was growing rapidly before it wasn't anymore. And this is around the time that Dieselgate broke. Now, for those people that knew the auto industry very well, when this issue broke and when it slowly started emerging that it wasn't just a small isolated incident, it became pretty apparent that this was going to be something that was going to damage Volkswagen's, VW's reputation for a long time and cost them a hell of a lot of money. So if you were invested in this behemoth, you probably wouldn't have sold out when it started dropping, because there would have been that doubt about this is a fantastic company and they'll be fine. But slowly, as more information emerged, as the cost and time cost, the dollar cost and time cost of it became obvious, the price just dropped and dropped and dropped and dropped. This is a monthly chart, by the way, ultimately losing 60% of its value over 5 or 6 months. Now, the temptation here is going to be to hang on to the position all the way down. But if you go back to the facts and also you examine the new information that's come to light, anyone that's been in business for any amount of time, you would have known that this is going to be a problem that plagues the company for many years to come. Even then, you probably would have not jumped out at the top. And so you would have had to say, all right, I'm cutting my losses. I'm taking a 20 or 30% loss because I think that I can put my money elsewhere whilst this problem works itself out. Now, I suspect that a lot of people didn't get out at this level. And so they rode this all the way down, 60% down, waited 2,000 odd days to break even, and then started selling out. That's a long wait and a long opportunity cost. They made no money during this entire time. Now, I know that VW sold off for a number of reasons, but I bet you anything that there were people, still trapped bulls is the term, that had bought it at this level that waited to sell out over here. So what would have happened if you had cut your losses? Let's say you waited until a minus 20% loss and you said, okay, fine, I'm going to put my money into the S&P 500. If you had done that, taken your 80% of the money that you had left, you would have doubled your money over the same period. So not too bad. If you had waited all the way until the bottom, until you were minus 60% down, a very painful place to be, and had taken what you had left, which was 40% of your original investment, and stuck it into a company such as Google, again, there is some hindsight bias here, you would have not only made your money back, but you would have made a decent profit along the way. And so what I'm showing here is that there is an opportunity cost to holding on to your losers, particularly when your thesis, your reason for buying that particular company has changed fundamentally. Now, there are a few different examples of negative examples that I could touch on, but let's look at a positive example. So AMD is a company that it's been around for a long, long time. I don't think anyone would have sat in for this 10-year period waiting out the flatness. And in fact, the fundamentals of the business weren't that fantastic through the 7-year period. However, things started to change around 2015, 16, 17. And you can see, without going back through all the news, you can see that revenue was climbing, operating profit was climbing, margins were improving. The world was becoming a place that needed more processors, and AMD was becoming better at making processors for the market needs. However, if you had ridden this little rally and you'd bought into the top of it, you would have, how long is this? Over 1 year later, you would have still been at a loss. And the next month, you would have just broken even and you would have been tempted to sell. This is natural, by the way. Almost everyone experiences this feeling. Over a year to wait an investment and not make any money is a long, long time. However, if you had stayed in, you would have enjoyed a subsequent climb of 131% over the subsequent, the next 4 months. So even though you had made nothing for 14 months, over 18 months, you would have made a 131% return. The challenge for us as investors is that you would have had to do nothing for a long, long time, despite the company being fantastic and sentiment being terrible, while the fundamentals were fantastic. And all of your gain would have come towards the end of that period instead of being evenly spread across that period. This happens so much, especially with companies that are high growth. Quite often they do very well. They've got fantastic fundamentals. The market buys them and buys them and buys them, pushes the price up. The price of the stock exceeds the fundamentals, and then there's some kind of a consolidation, maybe even a pullback, whilst the fundamentals catch up to the price action. Now, this doesn't just happen once in a while. You can see it happened over and over again for AMD. There were multi-month periods where you would have had to sit on losses or basically no price action at all, 0% gain, and then suddenly you would see a spike up that would be enormous, and it would make the time waiting worth it. This pattern is very common amongst a number of very successful high growth companies. You'll see Netflix, for example. There were many times where you would have had to wait for years on losses or absolutely no returns to eventually see huge, enormous upside. Once again, it's all about knowing what you own, why you own it, and if anything has changed, that means that business is no longer the quality business that it was when you invested in it. All right, and that's it. This is one of the most common mistakes I see, whether people are investing in stocks, whether they're copying popular investors on eToro. People wait through rough patches until they break even, and then they sell sometimes before the best part of that investment arrives. At other times, if you really feel like your investment is no longer worthwhile, you should sell out immediately and find something else that is worth your time and your money. All right, I hope that was useful. Let me know what types of videos you would like to see in this series, and I will speak to you soon. Goodbye.